Welcome to Understanding Business Valuation, Part 3. Let's jump right in. You need to understand how your business compares to others in terms of its value. Did you know that there are 6 million U.S. employer businesses, and of those 4 million, 4,000 businesses, or less than 1%, are publicly traded companies? Those publicly traded companies have business values between 10 million and 100 million. It's very simple to determine the business value of a publicly traded company. You simply take the stock price in the market and multiply it by the number of shares that they've sold, and that tells you the value of that business. That's called the market cap or market capitalization. I'm sure you've heard small cap, mid cap, large cap. Large cap meaning large company, large value. Small cap meaning small publicly traded company, small value. Keep in mind, there are only less than 4,000 publicly traded companies in the United States. Middle market companies. There are roughly 500,000 middle market companies, and they are companies who have values between 2 million and 500 million. But the vast majority of U.S. businesses are Main Street businesses or small businesses. 5.4 million out of 6 million employer businesses in the United States have a value of less than 2 million. It's very important for you to understand where you fit in, because a lot of the strategies that you'll hear about that are important for exiting or selling a middle market company are not the same as for a Main Street company. Let's explore some of the differences between Main Street and middle market to give you a better understanding of what the best strategies might be for you. If you recall, in part 1 of our business valuation series, our middle market multiple chart showed in 1997 middle market companies had sold for 9.5 times earnings. By year 2000, middle market companies were selling for 6.5 times earnings, and again, by 2005, they were selling for 9.5 times earnings. As we go on to our next graph, we see publicly traded, middle market, and Main Street companies. You'll note that publicly traded companies sell for a multiple of 10 plus times earnings. What that says is your return on investment in publicly traded companies is generally, on average, less than 10%. However, as we just saw, middle market companies sell for a 6 to 10 multiple. That's a 10 to 19% return on investment. And the 6 to 10 multiple means that it takes 6 to 10 years to recoup your initial investment in purchasing that company. But many Main Street businesses are surprised to find out that their company will only sell for 3 to 5 times earnings. Now that's a 20 to 33% return on investment, which is a high return. Again, meaning it will just take 3 to 5 years to recoup your investment. But it is also because they are very risky. Think about it. 98% of Main Street businesses fail. They're a very risky asset. There are a number of ways that you can evaluate whether you're a middle market or Main Street company. Main Street companies will have a value under 2 million. On your tax return, if your profit is under 500,000, you're a Main Street company. If your profit is over 500,000, you're a middle market company, and most likely your business is worth more than 2 million. If you're a Main Street company, you will most likely have sales under 4 million a year, and employees probably less than 20. Whereas if you're a middle market company, you'll most likely have more than 4 million in annual sales and more than 20 employees. Keep in mind that 90% of all United States businesses that have employees are Main Street companies, and only 9% are middle market. On Main Street, the buyers will usually manage the business, whereas in middle market, the buyers don't want to manage the business. Middle market buyers are very sophisticated investment buyers. When they buy a business, they're not planning on going in and running that business. The management team becomes very important. A management team that doesn't stay in place with the company after the sale doesn't drive as much value as one that does. It's a value driver, a driver of business value. But on Main Street, key employees can be very important employees who are instrumental to helping the operation run smoothly. They are not necessarily managing the business from day to day, but in helping facilitate the operation and maintain its cash flows, they can be very important. Another important key distinction is that when it comes to the sale, Main Street businesses normally obtain the highest proceeds from an inside buyer. You'll probably get 5 times earnings from an inside buyer, but if you sell it through a broker to a third party, you'll probably wind up with 3 times earnings. Whereas the best sale of a middle market company is to a third party buyer. In the middle market, if you sell to an insider, you only get 5 times earnings. Whereas if you sell to a third party, you can use a competitive bid process through an investment banker to create price competition for the purchase of your business and drive your multiple up to the 6 to 10 range. Some other key differences. The buyers on Main Street will normally have an SBA loan. SBA financing is available for purchases of Main Street businesses and functions very well there. The buyers will have to have good credit. On middle market companies, the buyers will generally have their own financing. SBA is not available because the values are too large and the SBA limits are available only up to a specific point. As we wrap up this series, here are some key takeaways to remember. Business valuations are a complicated process with over 50 variables taken into account when determining a business value in the market. One of the most important measurements is the USPAP required 3 valuation analysis approaches. The income approach is the best approach of the 3 when it comes to Main Street businesses. Cash flow times multiple equals value. Cash flow is the investment that a buyer is purchasing. Distinguishing what your business is in terms of Main Street versus middle market will determine how best to go about selling your business. Our Understanding Business Valuation video series is strategy number 1 of our 2% Club 5 strategies of financially successful small business owners. In strategy number 2, we'll show you how to use your business valuation in support of key IRS positions, tax positions that will minimize your taxes, save you money on taxes, helping you to build your wealth. In strategy number 3, you'll learn how to value your business like an investment. To this point, what we've talked about is how valuation analysts value a business, which is to a hypothetical, average, third-party buyer. In strategy number 3, we're going to show you how to value your business like an investment to a specific buyer and what the value is to that specific buyer as an investment. In strategy number 4, we'll go into great detail on exit, succession, purchase and sale, and show you how your valuation works in helping you win that process. And finally, strategy number 5 talks about protecting your wealth so you can enjoy the lifestyle you've worked so hard to create for you and your family. To learn more about the 2% Club Advantage, you can go to griffco.com. For a personal business valuation consultation, please feel free to contact Griffiths, Dreher, and Evans by phone, email, or through our contact page on our website.